If you're a travel nurse, you already know your compensation package is a totally unique beast, and honestly, it can be a massive headache to figure out. Unlike a traditional staff job, you're dealing with two very distinct buckets of money every single week. You've got your taxable hourly wages, and then you've got your non-taxable stipends. And let me tell you, understanding the strict rules around those two buckets is literally the absolute foundation of your financial success on the road. Because think about it, those stipends, which are meant to cover your housing, your meals, your incidentals, they are exactly what make travel nursing such a lucrative move. I mean, we're talking about stipends making up 40 to 50% of your total weekly pay. That's enough to completely change your financial trajectory, and it is completely free of federal income tax. But there's a huge catch here. You only get to keep that money tax-free if you legally qualify for it, and whether you qualify or not comes down entirely to how the IRS views your tax home. And guys, this is where the stakes get incredibly high. If the IRS audits you and decides to invalidate your tax home status, maybe because, you just used a family mailing address instead of a truly maintained residence, the consequences are brutal. Those stipends don't just magically become taxable for your future contracts, they become fully taxable retroactively. Every single dollar you already received tax-free suddenly becomes ordinary income. We are talking about potentially owing tens of thousands of dollars in back taxes, plus penalties, plus interest. Getting this right isn't just some minor technicality, it's everything. Okay, let's dive into this. What exactly is a tax home anyway? Most people naturally assume, oh, my tax home is just where I live or where my family is or where my mail goes, right? Well, actually, scratch that. The IRS defines it completely differently. To them, your tax home is your regular place of business or your main post of duty. But here's the problem. If you're a travel nurse working temporary assignments all over the map, you don't really have a single fixed regular place of business. So, because you move constantly, the IRS has to fall back on what they call a strict facts and circumstances test to figure out where your tax home actually is. And spoiler alert, they really don't care where your heart is, they care what the paperwork says. So, that brings us to the absolute core of this explainer, the infamous three-factor test from IRS Publication 463. This is the exact framework the IRS uses during an audit. Let's break these factors down, because the IRS uses them to decide if your permanent home actually qualifies to protect your stipends. Factor number 1, you've got to perform part of your business near your permanent home. Now, this doesn't mean you need a full-time staff job back home, but it does mean maintaining some professional activity. Think taking PRN shifts, keeping your state licensing active, doing your continuing education, or handling professional development right in the geographic area you claim as home. Then there's factor 2, and this is a big one. Duplicate living expenses. This means you're paying real ongoing financial costs at your permanent home, rent, a mortgage, utilities, property taxes, while you are simultaneously paying to live somewhere else for your travel assignment. The key word here is simultaneously. You haven't just abandoned your home, you're actively bearing the financial burden of keeping it running while you're working away from it. And finally, factor 3, used for lodging. Basically, your permanent home has to be a fully functioning residence that you actually return to. When you've got a gap between assignments or on your days off, you physically go back and stay there. It's not just an investment property that you rent out full-time to some tenant, and it's definitely not a P.O. box. It's your actual home base. Now listen closely, because this is the single most important rule to remember. All 3 factors are required. Not 1, not 2 out of 3, all 3. The IRS is super explicit about this. If you miss even one of these factors, they can decide your tax home has shifted to whatever city your current assignment is in. And the exact moment that happens, bam, your lucrative stipends are instantly reclassified as taxable income. Now, what's really interesting about this slide is how easily people mess this specific part up. Let's dig deeper into duplicate living expenses. The IRS wants to see a very specific financial reality here. They are literally putting your permanent home costs, your rent, utilities, insurance, right alongside your assignment location costs, like your agency housing or your self-paid rent. They mandate that these 2 sets of expenses must be happening at the exact same time. You absolutely must be duplicating your living expenses. So, just to be super clear here, duplicate expenses mean a real, documented financial obligation. Giving up your apartment lease, shoving all your furniture into a storage unit, and changing your address to your parents' house, yeah, that does not create duplicate expenses. That is just a mailing address. If you aren't paying fair market rent to your family and sharing the utility costs with a rock-solid paper trail to prove it, you are not duplicating expenses, period. You're failing the test. All right, let's switch gears a bit and look at the second major pillar of tax home compliance, the one-year rule. It's all about temporary versus indefinite assignments. Let's move to and see how this builds, because it's tricky. The IRS states your assignment must be realistically expected to last 1 year or less. So you start at day one, you're enjoying your temporary safe harbor, everything's great. But the tax home shift doesn't necessarily wait for the 1 year mark. It happens the exact moment your expectations change. Say it's month 6 and you agree to an extension that pushes you past that 1 year total. Well, your assignment stops being temporary on that exact day. From that moment forward, the IRS considers it indefinite.
And you really need to be careful here, because the IRS isn't just looking at the dates on one single contract. They look at the cumulative expected duration at a single location or facility. So if you're just renewing standard 13-week contracts back-to-back at the exact same hospital, you are inching dangerously close to that 1 year threshold. Extending continuously like that is a huge red flag, because it signals to the IRS that this place isn't a temporary stop anymore. It's become your regular place of business.
So what actually happens when you cross that line? Let's look at why a tax home shift is such a big deal. And this brilliantly illustrates the direct financial hit. On a temporary assignment, your travel's deductible and your stipends are completely non-taxable. It's beautiful. But if your assignment becomes indefinite, your tax home officially shifts. Instantly, your travel is no longer deductible, and all of those beautiful stipends become fully taxable as ordinary income. You are essentially giving yourself a massive pay cut overnight. No way you want that to happen. Okay, to help you protect your hard-earned money, let's review the most common mistakes that consistently put travel nurses in the crosshairs of the IRS. Here are the 4 biggest traps. Number 1, using a family member's mailing address without actually paying fair market rent. A mailing address is not a tax home. Number 2, renewing your contract past 1 year at a single facility, triggering that shift from temporary to indefinite. Number 3, abandoning your permanent lease or selling your house before you hit the road. Remember, no ongoing costs means no duplicate expenses. And number 4, failing to keep documentation. Even if you do everything perfectly right, if you get audited and you don't have the receipts, the lease agreements, and the utility bills to back it up, the IRS is going to rule against you. All right, let's wrap this whole thing up. So the crucial point is this. Protecting those tax-free stipends requires a highly disciplined, 3-pronged approach. You must have a genuinely maintained residence, you must incur actual duplicate cost while you travel, and your assignments must remain strictly temporary. You've got to actively maintain and document all of these things throughout your entire travel nursing career. This isn't a set-it-and-forget-it rule for your first assignment. It applies to every single contract you sign. Just take a moment to look at this final checklist. Maintain a real residence. Document your duplicate expenses like your life depends on it. Keep those assignments well under the 1 year mark per location. And keep meticulous records. Honestly, if you want to be absolutely sure your specific setup is compliant, we highly recommend using the Pay Decoder tool and checking out the full IRS compliance guide linked in the description. It will help you analyze exactly what you can safely take home. So, I'm going to leave you with this final thought before you sign your next contract. Take a hard look at your current setup, your paper trail, and your housing arrangements. Ask yourself, are your stipends actually protected against an IRS audit right now? Take the time to verify your compliance, you guys, because in the world of travel nursing, understanding these rules is literally the only way to keep the money you've rightfully earned. Stay safe out there.